Stephane, thank you very much for joining us today. One of the things I love about financial markets is that they're always evolving. We're always seeing new products and new concepts. And some of the concepts I want to discuss with you today include tokenization, stable coins, and also perpetual futures. But before we do that, why don't we start with a brief overview of your firm, FRNT Financial. Where is the firm based and what services does it offer?
Thanks, Jimmy. Thanks for having me on. So starting off, FRNT Financial was founded in Toronto. We've expanded globally since. I'm currently sitting in London. FRNT has an FCA registered subsidiary. We have people all down the East Coast into even the Caribbean, and then we touch Europe and we touch Asia as well. FRNT is what we refer to as a specialty digital asset investment bank. And so essentially, it's been created to service institutions as they enter and build out their crypto platforms, let's say. We service just like a traditional investment bank would, primarily, asset managers, hedge funds, pension funds, et cetera, on the trading side. And then on the corporate side, we cover, whether it's a Bitcoin miner or a new project and all of that kind of stuff. We're set up very much like a boutique investment bank would. The correlation I give to kind of traditional markets would be a commodity specialty investment bank, where we have two primary business segments. One we refer to as capital markets, which is our daily transactional activities. So that's physical, often block trading of cryptocurrency. We have a borrow lend desk. We have which has a lot of technology in it, and we broker transactions for the most part. And we have a derivative and structured products desk where we create, multi-leg derivative structures for clients, either trying to attack an opportunity via swap or some other kind of structured product, a CFD. And just do straight kind of futures, bilateral trades, options, bilateral trades. We then also have advisory, where, as I mentioned, we work with, digital asset companies, often private, that, aren't getting serviced in the right way from the bank. Sometimes that's just because we get it sooner. Our team's spent, for the most part, a decade in the space, and we can see the opportunity for a new build often quicker just because of the expertise that we have. And sometimes these companies want to do something the investment banks just can't, like raise money denominated in Bitcoin, bring in a line of credit denominated in stablecoin. And so we fill in those gaps where the traditional investment banks, don't participate. We also do consulting for traditional financial firms and others within that advisory segment. So that's FRNT.
Great overview. So you're the perfect person to speak to about some of the concepts that I mentioned. But before we do that, I want to get your views on what's happening with Bitcoin right now. We recently saw a sharp pullback in financial markets across the globe, and Bitcoin and cryptos got hit especially hard. And I read it was the largest liquidation event in crypto history. Bitcoin lost $19 billion in market value in a short period of time. US stocks lost $2 trillion. So I guess when you compare it to the US stocks, Bitcoin didn't really lose all that much. But what are your thoughts on the Bitcoin price, and does this volatility concern you at all?
So, a lot of like having the largest sell-offs or largest liquidations in history, when you're talking about it being denominated in US dollars, is a function of the market just increasing in size and going up a lot. So as the market makes new and newer highs, by definition, almost they'll have the largest notional sell-offs and the largest notional liquidations and all of that when being priced in US dollars, because we're at $120,000 Bitcoin right now, or give or take. We were at $120,000 Bitcoin. And, in the last market cycle, we only got up just above 65. So that's the first thing. It's kind of a product of the asset success. Secondly, the volatility and aggressive pullbacks have been, very much kind of, table stakes in digital assets over the years. There's a lot of reasons that contribute to that. I think the first reason is that you're dealing with a global asset that's growing from a standing start zero and is starting to emerge as a very big and important asset, but still relatively small. So you've got this, you've got the world kind of slowly getting into this asset. And as we know, when sell-offs happen, sell-offs happen more quickly than rises tend to happen. And just by nature of it being a relatively small nascent asset, a whole bunch of people get spooked because of a headline that has recently happened. It tends to just have these momentum waves where things sell off. In addition to that, there is a lot of leverage that is available in the crypto native landscape. So it's not leverage in the traditional sense where someone is, writing an over-the-counter loan to somebody, but there's a lot of CFD-like products. If your listeners are familiar with that, where there's embedded leverage, where essentially you can define the quantum of your move. So you'd say, if I want a $1 move to look like a $2 move, or if I want it to look like a $5 move, that just means that on the downswings, I could be wiped out of my derivatives positions much quicker than if I was just holding them fully collateralized. So there are a lot of kind of embedded leverages in the space. Retail, it's a really retail dominated market. They tend to be a lot more loose with leverage than institutions generally are. And so you do, just by the nature of, having these major momentum upswings, the downswings, particularly as the markets become more correlated with traditional assets because of things like ETFs being widely available and all that. Macro headlines have led to sell-offs, but I'll caveat that one of the best trades, of size over the last 18 months has been when a macro headline causes a risk-off trade, which brings down Bitcoin, to be a buyer. I mean, the first time this has happened in recent history was in August 2024, where the Fed, showed their hand that they would be cutting rates for the first time in the fall. It created a macro kind of upheaval where like major books had to shift to accommodate that, and Bitcoin sold off from about 70,000 to 50,000. It made no sense. Bitcoin is traditionally a market that does very well in fiat debasement cycles, which we're in and getting more aggressive. That would have been a great purchase to buy at 50,000. And I think we saw the same thing when we started to get the tariff concerns in Q1 of this year, Q1 and Q2 of this year. Those have been great purchases to make. So yeah, it's a lot of the macro concerns actually build out the Bitcoin thesis. So even though there might be a knee-jerk reaction lower, ultimately over time they tend to recover and make new highs.
So it sounds like you're not too concerned about this pullback that we recently saw. You see this as a buying opportunity?
I see this as a buying opportunity, makes the market healthier. When leverage gets extended, if short-term leverage gets extended, these moves are more likely to happen, and then it kind of sets up an opportunity for a new run. I'm talking about leverage getting extended, but we have not seen leverage get nearly to the levels that we saw in 2021. I mean, we're yet to really see the type of fear of missing out style momentum moves that have typically come at the top of market cycles as seen in 2017 and then 2021, where the internet attention and internet activity around Bitcoin searches and crypto searches just goes through the roof. Volumes still haven't hit like the levels maybe in US dollars they have had certain days because of the asset's appreciation, but actually in Bitcoin denominated terms, volumes are well off some of the levels that we saw in 2021. And we haven't seen the level of kind of mid and long-term leverage get to the crazy, crazy rates we saw in 2021. Like the level, I would have said that, the risk level for leverage, in the most recent liquidations that we saw was kind of yellow to orange. We've seen it go push right through yellow, right into orange and into the red. And that's kind of when you start to get these blow off tops that have typically come into the space. And, this market cycle's played out longer and we're yet to see that. So until we start to get the kind of activity that I described, and anecdotally, like every room I talk to is talking about crypto. I'm getting calls on the weekends from people I went to high school with that are asking me about how to work their Coinbase account, which is what I was getting in 2021. I'd like to think that the highs are not in, and I'd expect that we're somewhere between the first third and halfway through this market cycle would be my best estimation.
So quite often, Bitcoin is referred to as new gold or digital gold. So I have to ask you about this relationship now. And gold has done extremely well this year. It's up over 50%. Bitcoin's up around 20% on the year. JP Morgan recently said that Bitcoin is undervalued compared to gold. I'm not too sure how they came up with that analysis, but they also said they see a pathway to $165,000 for Bitcoin. What are your thoughts on this? Are you as bullish as JP Morgan is?
Yeah, I am as bullish as JP Morgan is. I think it's a question that I get it's, like, first of all, just talking about Bitcoin as digital gold, I think that as market participants that have been used to trading assets that have been around for a long time, people tend to define things having similar properties as having correlation, like a very tight correlation. And so, you know, the properties of Bitcoin and gold are very similar. I mean, in if you think about, it as being like a store of value or something that is something where you can self-custody. Maybe that's a better example. You can have your own private Bitcoin wallet and you can take a gold bar and leave it in a safe at home. That is very similar. You don't have to have an intermediary stand between you and your gold bar in the same way you don't have to have an intermediary stand between you and your Bitcoin. gold has not a fixed supply like Bitcoin does, but there is, a supply that isn't necessarily impacted by government policy or something like that. So there are a lot of properties to having gold. It's like the rainy day fund where if the banking system fails, I'll still have my gold. It's the same, it's a very similar argument with Bitcoin. So they do have very similar properties. As I was identifying where that tends to cause people confusion is they don't always have a tight correlation. And I think that there's a few reasons to that. First of all, I think that you've got to think about Bitcoin differently than you have to think about other asset classes. There isn't like a consistent new set of people that are learning about gold that didn't know about gold yesterday, that are ready to dive into gold for the first time. Gold is a very well-known story, and people have understood the value of investing in gold basically since they've entered markets. Like when you enter markets, one of the first lessons is when does gold typically go up? It's an inflation hedge, et cetera. People are still getting very heavily indoctrinated into that thesis for Bitcoin. So what tends to happen is that when you get these inflation, like you get some, whether it's economic data or some other indicator that inflation is going to spike, gold reacts immediately, right? What tends to happen in Bitcoin is that more and more people start to consider the possibility of basically hedging themselves out of the current financial system, the banking system, the fiat system. And that happens over time. It's not like everybody gets the same idea on day one. Someone who hasn't bought in Bitcoin before sees all the fiat currency debasement and might say to themselves, you know what? I should probably allocate 1 to 2% of my portfolio into Bitcoin because I see it as hedge these things, and they've never done it before. They might not decide to do that the second that a piece of economic data comes out, right? So there's kind of an other kind of adoptive force that it has this underpinning to Bitcoin, which tends to miss its correlations. In addition to that, it's relatively new. A lot of people disagree on what this asset is, whether it's a inflation hedge, whether it's a risk asset, whether it's technology, et cetera. And so you have moments in the market where the speculators who are also long NASDAQ and are also long, NVIDIA also buy Bitcoin. The market goes up. And then as the equity markets turn, let's say, they de-risk their entire book, which includes Bitcoin. And then what you tend to see is that and there's a lot of data that you can have on this in terms of wallet transactions, on-chain activity. You tend to then see, the speculators leave and it develop a new base out of people that are going, wait, the reason why I'm in this thing is because interest rates are going lower. The reason why I'm in this thing is because there's a global financial system that seems to be changing a lot and in chaos. And then you get find some support and it continues to kind of push higher. So, that's the way I'd characterize the gold and Bitcoin relationship. There are times where it does heavily correlate when the speculators are out of the market and everybody who uses an inflation hedge starts to buying. But if there's cross correlations held with other risk assets, it'll buy just technical justifications straight down with them.
And I think another characteristic or difference between the two is the demographics. I'm assuming gold probably caters to an older demographic. Bitcoin and cryptocurrencies a younger demographic. Would you agree with that?
Absolutely. I mean, it's, we're publicly traded stock. We're on the TSX Venture. So, I have to pitch to a lot of IAs that have been in the industry for a very long time and all of that. And you can see that there is something about value being held in the digital world because it's not something you can hold and all the usual reasons that seems to make it very hard to visualize for people in terms of what do they own if they've, if they're older. I mean, it's not a rule. Like there's all kinds of people that are very sharp on the space that are older, but it's a generalization, but you don't tend to see that more often. The younger generations, which are typically what, the younger generations' interests and adoptions typically are very good indicators of future success, are very comfortable with the concept of a digital asset. I mean, there are, people that play online trading card games, like on PC games where they play, whether it's FIFA or something. And these people are spending thousands and thousands of dollars a year on buying a digital trading card that in most cases only has a 1 year life cycle. And then the new game comes out and you can't even use it anymore. Like this is not an unusual concept. And the things that are kind of that people have heuristics around in terms of how they assess value for a younger generation are just totally different. Like it's a complete, like people who have grown up with the internet and grown up with computers feel as though things that are on the internet are valuable. their attention. There's all these, other kind of real world items that you could associate with why they have value. But it's not a hard thing for a 25-year-old to wrap their head around. And it does seem to be a tricky thing for a 65-year-old to wrap their head around in many cases.
Yeah, you raise a very interesting point. And here's something I read recently. On any given month on YouTube, there's 5 to 6 million searches on anything and everything to do with trading, equity trading, FX trading, whatever. But there's 50 to 60 million searches on sports betting. So it's the same sort of thing. We have this younger generation that are really into sports betting now. It's almost become
Yeah,
like a
I think that
gamification.
there's also some economic factors, I think. There's a gamification element for sure. That's kind of a new kind of online concept as well. But, the when I grew up, if you were the top of your class as a lawyer you made partner at a firm, you'd be extremely wealthy in buying a house in the nicest area in town and all of that. Now, the people that are doing that, now, like, forget the lawyers. Like, if you're not, in one of those high paying roles, you're trying to figure out, like, how am I going to buy a house? I can, like, my account is at zero every month. Like, this is the situation that many millennials find themselves in. If they don't have any inheritance or anything like that, they're struggling to keep their head above water. So the idea that I'm going to earn 8% annualized in a dividend stock, like, you used to be able to do that math and go, oh, then I'd be able to buy a house by the time I'm 40. The math doesn't work anymore. It just doesn't work anymore. So people are looking for windfalls. And they're looking at sports betting because, there's a lot of different elements of sports betting where you can convince yourself that you're going to hit a 16 leg parlay on the weekend and you're going to be able to quit your job on Monday. So, the companies are really playing on that angle. But in crypto, you can hold a token that doubles in a year. You can hold a token that doubles in a week. And so it continues to draw this attention from these people that feel like they need to have a windfall to get where they just expected they would in life, you know?
Okay, so speaking of windfalls, let's talk about perpetual futures now. And this is something else I keep reading about. 70% of all Bitcoin trading volume is through perpetual futures. What exactly are they and why are people so interested in them?
Yeah, so perpetual futures are a concept that emerged out of digital assets. They're not something that's well recognized on Wall Street, and I would imagine, like, I haven't done it for a while, but years ago there would be a very small percentage of Wall Street traders that even knew what they were. And today maybe it's more like 50%, but it's still, even to like very sophisticated derivative traders, a concept that isn't on Wall Street. And the primary reason for that's able to exist in digital assets is because of 24/7 markets. And so what a perpetual future is, it's a future that never has an expiry date. Okay. And so how do you launch a future that never has an expiry date? Brief overview of futures. The reason why the underlying and a future stay relatively connected throughout their life history is because that on the expiry date, the future and spot are going to close at the same level. So that's known. So there's an added incentive for arbitrageurs if the future, because people just say someone's outright buying the future and starts to bring it beyond the spot level. If I buy spot and short a future and put on that basis trade, I'm going to get that spread on expiry, right? So how do you incentivize the arbitrageurs to maintain that spread if there is never an expiry date? Right. And so that is the mechanism that was kind of the innovation of a perpetual future. And the way that they're operated is that and there's a couple different models for it, but the model that really BitMEX popularized, which is kind of the main model and the way Binance operates their perpetual swaps, is that there's 8 hour windows where they have an equation where they look at the book, and if longs are outweighing shorts, then at the eighth hour of that window, they a little bit before they start to announce what the incentive is to go the other way. So they'll basically say for the next 8 hour window, we're going to pay shorts, this many, daily basis points, like prorated, which incentivizes the shorts to then go long, which then incentivizes someone, if they're trying to incentivize shorts, to buy the underlying spot asset, short the perpetual swap, and get the interest rate implied by that. And that's been a very popular trading strategy. It's been a very attractive trading strategy because in these really aggressive market moves up or really aggressive market moves down, retail tends to dominate one side of the book. and taking the other side of retail has created a really strong annualized trade opportunity where your only risk is operational and counterparty risk to the platform that you're working on. So this is something that I've been involved in hedge fund launches in the space, and this has been a really, really attractive trade that FRNT has tried to pitch to regulated institutions over the years via derivatives and regulated swap products that they can access. But that's basically it. It's a future that never expires, and the reason why they're able to maintain the perpetual swap price to the underlying is because of this 8-hour window mechanism where longs pay shorts, where shorts pay longs, based on the way that the book is weighted.
And is one of the reasons why the retail investors are embracing this concept, is it because of the leverage associated with these futures?
So what brings them to the derivatives space in digital assets is the leverage. So they say that like, okay, yeah, I want to buy Bitcoin and I want to have this leverage, and it's easier to bet leverage into derivatives than it is in a spot margin lending account, let's say. Okay, so they've gone to derivatives. Then they look at a future, and then they look at a perpetual swap. The perpetual swap just makes more intuitive sense to most retail traders. That's basically what it comes down to. And so perpetual swap liquidity is much higher than futures liquidity in digital asset markets because you can imagine like a retail trader with very little experience coming to trade, a Bitcoin derivative for the first time, and they're wondering, wait, Bitcoin's trading at 115. Why am I buying something at 116? And that dynamic playing out. Although the futures typically have about as much leverage as perpetual swaps. The perpetual swaps, it's trading about around the spot rate. It would be very, very close to the spot rate. And then there's this like 8-hour, I got to pay a couple basis points here and there. I don't even know what that is. And so they just buy it because it just looks like very leverageable spot.
Coinbase recently increased the leverage to 50 times on international perp futures. Thoughts on this? Like to me, 50 times is just insanity, but what are your
Yeah,
thoughts?
I mean, there's the platform that really kind of uh, caught kicked off the development of perp futures, which was BitMEX, always had 100x leverage. So 50x is not like a new concept. That Coinbase derivative exchange is not like a widely accessible exchange, like unless something's changed recently. It's like basically like this whole derivatives exchange, like it was a kind of a Coinbase response to the last administration. They were trying to get a derivative exchange through in the US and they couldn't. So they kind of like threw their toys out of the pram and said, well, we're going to create an international derivative exchange. So, where we can do all of these things and, you're not going to have jurisdiction over it. And it was kind of like a little bit of like, an argument with Gary Gensler's SEC that led to that. The reason why leverage is also interesting otherwise in the space is because it's very useful for market makers. Like a market maker can access, they have to manage their own risk, but they can put a little bit of equity on a platform, do a trade, and it's helpful. Maybe it's offset by something else on another exchange or on the same exchange, et cetera, et cetera. So it's not just for incredible retail leverage. And I don't really even know how much access retail has to that Coinbase exchange. So, from my perspective, like they're getting a headline out around the international exchanges development. I've seen higher, there's 150x leverage on some platforms. Binance did that. So it's not a new thing. It's like even on BitMEX when they were kind of the kings of this world, the principals would say that the average leverage rate on the exchange is 8.5. We have 100x as like a marketing tool.
I want to move on now and discuss tokenization. The CEO of Robinhood, Vlad Tenev, said the tokenization of real world assets from stocks to real estate will spread to financial markets around the world. And he went on to say that tokenization will be a freight train and it can't be stopped, and eventually it will eat the entire financial system. What is tokenization and why does Vlad Tenev think it will eat the entire financial world?
Yeah, so I mean, tokenization, the best corollary to what a token is and like a real world tokenized asset is an ETF. It's a version of a receipt on assets held in someone else's custody. That's basically what it is. So the benefits of an ETF over the benefits of a token over an ETF are, if you don't think about the counterparties that are issuing them or whatever, would be that, they trade 24/7. They have far faster settlement, like, equity markets, when I start equity markets, there's T+3 and they're all kind of trying to make it faster. But I mean, you can settle a tokenized trade in minutes and sometimes even faster than that. If you're dealing outside of the existing financial system, there's no wires involved. I'm sending you one token, you send me another token. It's relatively instantaneous. That, as a result, they trade 24/7. And there's a lot more that you can do with it. You can pledge them as collateral as a retail trader much more easily. So you can, I have this equity in this account and now I can buy this thing. It's much more easy to margin. There's a lot of disintermediation from the token world that you don't need, a custody agent. You can hold it yourself. Like there's all kinds of, like, on almost every vertical outside of, track record, how long it's been around for, and counterparty risk in the industry. Like, the tokens, just by their nature, kind of dominate, all other ownership representation mechanisms. Like that is, I mean, there's like exceptions, and I'm sure someone could tell me, well, what about this case? And I'd go, okay, there, yeah, you're right. But the thing about tokenization is that tokenize this narrative around, in 2018, people would say blockchain, not Bitcoin, right? Like they'd say, and now it's like real world tokenized assets. Like in every market cycle, it's said a little bit differently. But, a lot of the reason why this has gotten steam was because of a way to, like, not make yourself look like a dinosaur and say that, like, I don't think any of this stuff works, but by the same time kind of put down Bitcoin. And because Bitcoin is such an inconvenient truth to the financial system. It's something that so many people just don't even want to exist. Like, it's too weird, get it out of here. But I'm not a dinosaur. I like blockchain. I just don't think Bitcoin's going to turn into anything. Saying that the one thing that blockchain technology has been used for to turn into a multi-trillion-dollar market is the thing that doesn't work, and everything else that's really not seen any adoption at all is the thing that is always a little bit at odds, right? But the issue with tokenization, like the way that tokenization is thought of, is that I'm not gonna have to go to a central registry to re-register a real estate sale. It's just gonna be, I'm gonna send the guy a token. He owns the building now. I can then take that token and put it as collateral to buy gold with. It's that kind of thing that people are thinking about, just like an incredible amount of interoperability, which, if you could snap your fingers and just have everything move to a tokenized world like you would, I mean, it does make a lot more sense. But the problem is the switching costs. I mean, the idea that every NASDAQ stock is just going to become tokenized one day is probably one of the biggest technical, engineering, like, ideas that I can imagine. Just like, it's from a software engineering perspective, it'd be crazy. You're putting an entire financial system probably at risk in this transition. And so, the best way for the US to do tokenization is kind of what's going on. It's like, okay, you tokenize this one stock, it also trades on the New York Stock Exchange. We're going to create some mechanism where we're going to recognize them as fungible, and we'll see how it goes. And it kind of builds out slowly over time, which is probably what's going to happen. It builds out slowly over time. Maybe the next company that gets launched via it, like, makes big IPO, ends up just going down the token route, and then other companies do, and then all the new companies are tokens and the old companies are stocks, and something like that kind of plays out. But where I think that this is a real kind of, this is happening right now thing, is in countries that don't have very good centralized systems, which is like the old systems. So, like in Colombia, for example, like there's also often two parties that say, I own the same piece of land, right? We don't really have that issue in Canada or the US, right? Like, especially on land. I mean, occasionally, but it's not like a consistent problem. In Colombia, it's every day. And so we're working with a company that's trying to build out kind of tokenized ownership proofs via, tokenization, blockchain, et cetera. So that, like, if you show up to court and he's got a deed that you say is forged, and you've got a deed that says is forged, well, at least I have a token that says that it's mine, and that's a little bit better than a guy who doesn't even have a token, right? So, these places that don't have good, like, prior generation systems may just skip those systems altogether and move to a blockchain-based system because what they have isn't working. In the West, there's this issue around, like, our real estate directories work quite well and all of that. So, like, who's going to want to just switch the whole things overnight to something else, and to what benefit to them? And you get into all those kind of questions. So, I do think it's something that's on the horizon. I think it's a very hard thing to handicap, what, how long it's going to take for this to get some serious adoption. I think it's probably going to be two steps forward, one step back with different political regimes coming in. This isn't something that can happen overnight. So you get a pro-tokenization regime and then an anti-tokenization regime because they're funded by people that it doesn't help. Like, I mean, already, like Trump went really hard with trying to create a plan like that. And like Citadel's the first people to put up their hands and be like, this is just taking an incredible risk with the equity market. They're also kind of talking their book, but you're going to get a lot of that too. So, tokenization, I agree by all looks of it. Tokenization is the path of least resistance. Still, it will still meet resistance along the way. It's definitely not an overnight thing or a straight line.
Now, there are companies that are trying to tokenize gold, and I'm curious about this concept. But as an investor, like, why would I want a token on gold? Why not just go out and buy the GLD or buy physical? What are the benefits of that?
Yeah, and tokenization also, I should say, like there's easier things to tokenize than like the US equity market and all of that. And we've already seen a lot of success in tokenization with US dollar tokenization, right? Like Tether is now like the 15th, I believe, largest holder of treasuries. They have like an over $150 billion of balance sheet. And basically what that is that I send a wire like basically I send a wire to a stablecoin issuer, say they're a US dollar stablecoin issuer, and they give me a digital representation of that I can quickly move around the crypto ecosystem. Whereas if I have to send a wire from one crypto exchange to another crypto exchange, now I got to go through Swift. It might take 3 or 4 days. And if I'm a trader and I need to move something quickly from one exchange to another exchange, or if I want to settle something quickly, a tokenized representation of my dollar has a lot higher velocity than a US dollar held in a bank account. So that's, and like those guys have had an amazing business model because they don't pass on the interest rates to their clients. So where we've seen the spike in interest rates over the last few years, they've captured all of that, in the same way that a lot of banks do. And they've become one of the most profitable firms in the world over the last few years. So the tokenized gold element is an extension of that model, and it is very similar to the GLD. I mean, basically, what happens with tokenized gold is that I go to an issuer or a market maker, as you do if you're trading the GLD, and I say, hey, I've got 10 million bucks, and I don't want to buy physical gold because it's just going to sit in a vault in Switzerland, and I don't want to deal with all that. So just give me exposure to it, and I'm happy to pay a couple basis points for you guys doing all that in the background, holding the gold on my behalf in your vault, and you give me a receipt to your vault. That's what the GLD is. Because it's gotten so big, it also has some derivative components in it. It's not just physical gold and all of that. I'm sure a lot of your listeners are well aware of that. The XAUT and other gold-backed tokens are the same. You go up to a market maker or issuer, you say I have 10 million bucks and I want a sub-receipt representation. Instead of getting that in an ETF wrapper, I get it in a tokenized wrapper. And the benefits are the same as I was describing for tokenization over stocks. You can trade it on the weekend. It's much easier to move to collateral. If I could actually pay for something with tokenized gold, I could hold tokenized gold in my wallet. And if somebody goes, hey, this thing costs 10,000 bucks, I could go, I'll just send you 10,000 bucks of tokenized gold. And they go, okay. And they can sell it immediately or they can hold on to it or do whatever they want because that's the way you operate. If I wanted to buy like a boat with my GLD position, I couldn't. So it dominates the GLD on a lot of elements. Probably a little bit worse on liquidity, but not really because you can always just go back to the issuer and they're going to issue it essentially at par with a little bit of fees. So that is and tokenized gold is an easy one because I can just decide to launch my own tokenized gold coin at any point. And people might not buy it, but I can do it versus where you're talking about shifting the New York Stock Exchange and all their assets to being tokenized. I got to get the New York Stock Exchange to agree. I get all the investors to agree. I got to get all the operating systems to agree. I got to get the companies to agree. It's just a way larger exercise. Just like if I was a company and I wanted to launch my own token, it'd be easier. If I'm an issuer and I want to launch my own ETF, it's easier than if I want to just change the existing paradigm to something completely different that's already working pretty well.
Just a couple of points I want to clarify. You mentioned Tether, and Tether is a stable coin, which is an example of tokenization of a real world asset, in this case, the US dollar. Is that correct?
So Tether is the issuer. Their US dollar stablecoin is USDT. So Tether is like the issuer, just the same way that BlackRock would be. And so, it's colloquially because it's so dominantly their largest product, this US dollar project, that's often referred to as Tether. But it's Tether's actually the issuer. They issue USDT as their US dollar stable coin, and for example, XAUT as their gold backed token. So, but yeah, I mean, Tether, the Tether gold token is only a couple $1 billion, and the Tether US dollar stablecoin is well into the billions, so the hundreds of billions. So it's just often colloquially referred to as Tether, but that's the real breakdown.
And you mentioned that Tether is one of the largest holders of US Treasuries. Maybe you can just elaborate on that concept and how does that work exactly?
Yeah, so Tether's business model is basically to hold, like historically, their business model was to hold US dollars in kind and buy US treasuries and hold them in US treasuries and get the yield. I mean, this is a company that started it around 2012. You had basically a zero rate environment for a very long time. So, it wasn't that big a deal that they didn't pass on the yields because it was nothing. It was it and they weren't making a lot of money because they have some fees on create redeem, but it's not nothing huge. So that company wasn't doing a whole lot for a long time and dealing with a lot of like DOJ investigations because it was new and they were dealing with the US dollar and a whole bunch of like fear, uncertainty, and doubt that was bandied around the media. And it wasn't, you could argue it wasn't really worth it for a long time until the rate cycle starts to increase. And now, as this token has grown with the gold ecosystem, the crypto ecosystem as a whole, because it's basically an enabler to get into crypto. It's like a fiat on ramp essentially, not to get too much into that, but it's grown with the industry. Now with rates at, where T-bills are trading 4 to 5%, they can put that whole thing in T-bills and get 4 to 5%. They do some other things, with it, some different over collateralized lending strategies, which they now have gotten into. Basically, that was their strategy the whole time. When rates went to zero, they changed their policies to basically like be like, we're always going to have more US dollars in our account, but we might actually buy things like commercial paper now because we're not able to do this just on the back of US dollars. So they actually built about a 20% position in commercial paper. So, which, some people didn't like, but it's essentially kind of, it's a money market fund where you don't get anything back from it. What you get is the velocity of a dollar in digital assets, which is worth a lot to people.
Well, Stefan, this has been a great conversation. I want to thank you very much for spending time with us today and sharing your thoughts on Bitcoin tokenization and also stable coins. And as we wrap up, if someone would like to learn more about your firm, FRNT Financial, where can they go?
So yeah, I have to say we're publicly traded under the ticker FRNT in Canada and in the US under FRFLF on the OTC markets. Our website's great. FRNT.io is our website. We also have a very strong presence on LinkedIn. I'm often posting corporate developments. We have our LinkedIn page is posting corporate developments. We're also very often quoted in Bloomberg articles and stuff like that. So if you keep an eye out for us, you'll generally see what we think. And also, we're in the business of educating institutional clients about this industry. So us getting an inbound call from someone who's trying to figure out how to get their firm operating this industry is what we do. Like we're here to help. If you're confused, you don't feel like you have the internal expertise to figure it out on your own, but you feel like you're missing an opportunity, call FRNT. We're one of the only partners that is designed to do that.
That's great. And I will include a link to your website in the show notes below. Once again, thank you.
Thank you very much.